You're listening to a production of the National Media Archive. To learn more or volunteer, go to nationalmediaarchive.com.
Let me start with a question. If tomorrow never came, would your loved ones be financially protected? For many, life insurance feels like an afterthought, something you buy when you're older or wealthier. But here's the reality. Life insurance is the backbone of a solid financial plan, yet 50% of Americans don't have any. Why is that? Often, it's because we underestimate our vulnerability. I used to believe I was invincible, couldn't even catch a cold, let alone worry about the unthinkable. Sound familiar? Yet, life is unpredictable, and the best time to secure coverage is when you're young and healthy, locking in the lowest possible rates. So, let's unpack the most common misconceptions that keep people from getting covered and why it's time to rethink your approach to life insurance. Now, you might be thinking, isn't life insurance for parents or retirees? Actually, your age is your biggest advantage. Insurance premiums are calculated using actuarial tables, basically statistical charts that predict life expectancy. The younger and healthier you are, the lower your cost per $1,000 of coverage. Imagine buying a lifetime supply of coffee at today's price instead of tomorrow's inflated rate. By waiting, you're not only risking higher costs, but you might lose eligibility altogether if your health changes. So, why put off peace of mind when it's cheapest and easiest to get right now? Let's get real for a moment. Mortality rate and insurability, two technical terms that sound clinical, but they're the heart of this discussion. Mortality rate is the statistical likelihood you'll pass away at a given age, and insurability means your ability to qualify for coverage. No one has that proverbial crystal ball. Illness or accident can change your insurability overnight. I know it's uncomfortable, but ask yourself, if something happened tomorrow, what would your family do? Ignoring the conversation doesn't change the facts. Preparing now is an act of love and responsibility, not morbidity. Here's a shocking statistic. Of the 50% of Americans who have life insurance, 30% are underinsured. What does that mean? Underwriting and death benefit industry terms matter here. Underwriting is how insurers assess your risk before issuing a policy. Death benefit is the payout your family receives. Most people buy a policy once and never upgrade, even as their income and expenses grow. Let me tell you a story. A client making $100,000 a year had a $250,000 policy. When he passed, his family's financial needs far exceeded that payout. The rule of thumb? Aim for 10 to 12 times your income in coverage. Think of it as income replacement, not just the lump sum. Don't leave your loved ones shortchanged. One of the biggest barriers is cost. But is life insurance really as expensive as people think? Let's talk about premium and lapse rate. Premium is your monthly or annual payment. Lapse rate is the percentage of policies that expire due to non-payment. Agents actually have a vested interest in keeping your policy affordable because high lapse rates hurt their reputation and business. If someone tries to oversell you, walk away. There are millions of agents willing to work within your budget. The bottom line, there's a product for every income level. Don't let price anxiety keep you from the protection your family needs. Let's do a thought experiment. What happens to unpaid debts and funeral costs when you're gone? The answer, liability transfer and cash liquidity. Liability transfer means your debts don't automatically disappear, your family may inherit them. Cash liquidity refers to having money available immediately for expenses. Funeral homes deal in cash, not credit cards, and the average funeral can cost $7,000 to $12,000. I've seen families forced into GoFundMe campaigns, delaying closure and compounding grief. Life insurance provides near-instant liquidity, letting your family grieve without financial chaos. Isn't that relief worth planning for? Here's where most people get stuck. Term versus whole life, IULs, riders the jargon, can be paralyzing. Let's simplify. Term insurance covers you for a set period at low cost. Whole life builds cash value and lasts your entire life. Riders are policy add-ons, sort of like customizing your car with extra features. Don't be intimidated by options. Find an agent who educates, not just sells. Remember, you don't have to become an expert overnight. Just ask questions until you're confident about what you're buying. The right policy should evolve with your life, growing as your needs change. Let's talk about policy review and death benefit inflation. Policy review means checking your coverage as your life changes. New job, marriage, kids, a mortgage. Death benefit inflation is the idea that what seemed like enough money years ago might not be enough today. Picture this. You buy $1 million policy in your 20s, but by your 40s, your income and expenses have doubled. If you don't upgrade, your family could be left with less than they need. Treat insurance like any other financial asset, review it regularly, and adjust as your world grows. Why do we put off what's most important? Behavioral economics calls this present bias way focus on today's wants over tomorrow's needs. Let's get practical. It's easier than ever to get life insurance, even a term policy, in a few days with minimal paperwork. Whole life policies take a bit longer because of stricter underwriting, but delay only increases the risk that you'll lose eligibility. Don't let procrastination rob your family of financial security. Take a moment, look around. If something happened today, would they be okay? If not, it's time to act. You might be thinking, I've got investments and savings, why bother with insurance? Here's the catch: liquidity and probate. Investments often take time to access and can be tied up in probate, a legal process that can last months or years. Life insurance pays out tax-free, outside of probate, giving your loved ones immediate support. It's not an either, or insurance complements your wealth plan, acting as seed money to keep your investments intact. Don't let tax implications or legal delays upend your legacy. Insurance is the only asset guaranteed to pay when it's needed most. So, what's the next step? Start with a needs analysis. Figure out what your family would need to maintain their lifestyle if you were gone. Look for policies with flexibility, convertible terms, adjustable premiums, or cash value accumulation. Work with an agent who will serve you for life, not just at sale. Remember, this is about more than money. It's about dignity, security, and love. If you're ready to move forward, take a quiz or consult a trusted advisor. Your future self and your family will thank you for making this decision today, not someday.